Hi, this is Morgan Smith, and let's talk cash balance plans. Specifically, we're going to review some actual business owner Q&A that I had with a business owner who was interested in a cash balance plan, and he just kind of wanted a general understanding of investments and accounts. And so we're going to go ahead and kind of review those. I thought it'd be interesting for other folks to hear what we were discussing. So, again, my name is Morgan H. Smith Jr. I'm a partner advisor with WorthPoint, and I focus on cash balance plans, retirement plans, and 401ks for business owners. I can be reached at morgan.smith at wpwm.com, 800 620 4232, extension 708. All right. First question the business owner had was really how do the accounts differ from a 401k? So let's look at a 401k first, kind of remind ourselves there. And let's assume with this 401k, it's just a plain vanilla, uh, only participant deferrals into the accounts, no employer profit share or matching. So again, the way this works is you have each participant, you're going to have the business owner typically and the employees, and each participant is going to contribute their own a portion of their wages into their own separate 401k account. So each person contributes their own money and they've got their own separate account. They're going to get separate statements. They can perhaps log into their 401k portal and look at their accounts at any different time and see what the value is and all that good stuff. Again, the individual participants are going to have their own trading strategies and investment strategies within each account. We'll touch on that. So that's how we know a 401k works with each particular account. A cash balance plan, on the other hand, is much different. In this case, the owner only is contributing to a cash balance plan. Now, the first question is, why is the owner only doing this? Well, it's typically when you structure these cash balance plans, and the reason why business owners really like these is there are going to be some significant advantages from a tax savings standpoint over the years and kind of turbocharging your retirement savings. Nonetheless, the owner is contributing all the money and it's going into a pooled account. Very much different. There's no, than a 401k, there's no individual accounts for each employee or participant. And this pooled account that the money is being contributed for is for the business owner and all eligible employees. Now, the question came up, hey, how are you able to track how much each person is owed? Yes, most definitely. The actuaries are going to take care of that on a, basically an accounting standpoint, and you can get reports on that. Typically, these reports are done every year, and you can look at that and see how much money or benefit amount is allocated to each participant. So even though you don't have individual counts, you can still understand how much, say, for example, you as a business owner, how much benefit is yours. Another important thing that we'll expand on is there are no individual trading strategies. So here, each account and each employee or participant can have their own individual trading strategies. In a cash balance plan, typically you're going to have one investment strategy for the whole pooled account, and this becomes very critical. It's much different than what you'd be used to, and we'll look into that a little more on why you would really want to explore professional investment management on the cash balance plan, if not the 401k as well. So for the 401k, let's talk about this idea of how the investment portfolios work and the rate of return and some of those issues. Definitely a question that the business owner wanted some answers to, and just kind of wanted to clear this up. So again, in a 401k plan, each participant structures their own investment strategy. The rate of return determined by each participant's portfolio performance can vary significantly across employees and participants. So, for example, the owner may be older, they may be a lot more conservative, and they maybe have a young employee who's very aggressive different time horizons, different goals. The investment strategy can vary significantly across participants, and there's no real specific outcome defined. So you're basically defining what you can contribute, and the outcome of each particular account is going to be based on the amount of money invested and the investment strategy and how those investments have performed over time. Cash balance plans, very much different. The owner is going to structure a pooled account for the investment strategy for the pooled account as a whole. So you've got to come up with an investment strategy that is very different from a 401k plan. And we'll talk about this a little more, but you really want to look at reducing the volatility, the annual volatility in a cash balance plan. The growth of an account in a cash balance plan is determined by the interest credit rate, which is written into the cash balance plan documents. Typically, we're seeing 4%, 5% as an interest credit rate. What is an interest credit rate? I've got that in other videos, a little beyond the scope of this. But again, the second factor to the growth of the account of a cash balance plan is the employer contributions on an annual basis. So very different from a 401k. There is a investment return element that plays into employer contributions on an annual basis, and we'll talk about that a little bit more. In a cash balance plan, the specific future benefit is predetermined. So over here, there's no predetermined benefit. You're just predetermining the contribution. That's why we call this a defined contribution plan. In a cash balance plan, the future benefit is predetermined, and the owner has the obligation to ensure the outcome is achieved. So we're defining the benefit. That's why these are known as defined benefit plans. Again, in contrast to a defined contribution plan, such as a 401k. So let's look a little bit more into the goals and process, which are vary significantly between a 401k and a cash balance plan. Again, in a 401k, the owner and employees, or you could just say participants, contribute to their own account each year if desired, up to the defined contribution amounts on that year. So the year one, the eligible employee and employees or participants contribute. The portfolio performs in each account as it would based on the investments, and this happens throughout the life of the plan or the life of the participants' participation in the actual plan until either they retire, the plan shuts down, or they roll their money out of the plan. And then at the end of that whole process, there's some benefit. We don't know what that's going to be, but it's a future benefit whose dollar amount is really undetermined as the years go on. In a cash balance plan, as a reminder, the owner is required to contribute all the funds into one pooled account at various levels each year. Now, what we do in a cash balance plan, we actually reverse engineer the process. So you start off by determining a future predetermined benefit for each employee. And that future benefit right now in 2024 is defined and set at $3.4 million at age 62. So then the actuaries, they project out and then they reverse engineer that back, and then they will tell you what you can contribute from maximum and minimum standpoint each year. And at the end of each year, based on the interest credit rate, the amount you contributed, and again, investment performance will have an effect on this. They'll do a testing each year, and you'll get a report at the end of each year, and it'll tell you how much kind of a range in which you can invest and contribute to the pooled account the following year, with the idea that they're giving those recommendations based on a predetermined benefit for each participant of 3.4 million out at age 62. So very different. And again, This requires a much higher level of expertise from an investment standpoint. There are some gotchas if you don't do this right, based on things like, basically, you don't want too much volatility in the cash balance plan. It's much different than investing in an investment account like a brokerage account or a 401k, and highly recommend you get professional management within a cash balance plan. Okay, so let's look at how to invest and how they interrelate to each other. So in a 401k, again, you have each participant structuring their own investment strategy, and a lot of 401ks, each participant is kind of left to their own devices, and this sometimes can cause issues. A lot of participants, they're too busy, they don't keep an eye on their investment portfolios, they really don't know what they don't know, and maybe they're talking to their neighbor or friend or a colleague about how to invest, and they'll just throw their money into those accounts. That's why we, as an investment advisor, I work with a lot of business owners who have 401ks, and I am structuring individual customized portfolios for each participant and managing those on behalf of the participant. And so it's a real benefit for the participants, where they're getting professionally managed investment portfolios that are getting rebalanced, and they know they're on track and they have some peace of mind. Also can lower the liability for a business owner. So you, as a business owner, you do have some liability as to the outcomes and how the 401k works. But within the constructs of a cash balance plan, oftentimes what we do is a cash balance plan is going to be integrated with a 401k, and it's often going to have a profit sharing element to this whole kind of cash balance ecosystem. Again, in the cash balance plan, the owner is going to structure this pooled account, and the growth of the account is determined again by the interest credit rate, employer contribution, investment return. The big thing here again is the owner has the obligation to ensure the outcome is achieved. Remember, we talked about that 3.4 million at age 62. So it comes, I think, really critical here to get appropriate advice and professional management in the cash balance plan, because it's a much different strategy than what you're used to in these individual accounts. Maybe it be your own investment account or a 401k. So that really sums up the questions and the Q&A that I had with this business owner. Hopefully you found this helpful. You know where to find me if you have any further questions. On that note, have a great day, and we'll see you on our next video, whatever topic that might be. Take care and have a great day.